interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Welcome back to the Raw Selection Private Equity Podcast, interviewing the leading private equity executives and unlocking their secrets to success. Joining us today is Matt Frankel, Managing Partner at Levine, Leichtman Capital Partners. Welcome, and thank you very much for sharing your insights today, Matt.
Thank you for having me on, Alex. I really appreciate it.
Excellent. As per usual, Matt, if you could share with us a 60 to 90 second breakdown of you, please.
Sure. So Levine Leichtman Capital Partners is based in Los Angeles, where I live, married with 3 children. I actually grew up outside of Los Angeles. I got my undergraduate business degree at the University of Southern California. While there, I took a keen interest in finance and investment banking. And I had a wonderful professor who helped me get some internships in investment banking at a firm called Barrington Associates in Houlihan Lokey. I was able to parlay that experience into a full-time position with Bear Stearns in their Los Angeles office for investment banking, which is where I started my career. After spending a few years as a generalist investment banking, doing equity offerings, credit offerings, M&A, et cetera, I went on to go work at a firm called American Capital, where I cut my teeth in private equity. I spent almost 7 years there, learning the business, growing, getting experience. And then I joined Levine Leichtman Capital Partners almost 12 and a half years ago at this point, and have been there ever since, and worked my way up to managing partner a few years ago.
Congratulations on that. Partners always a fantastic spot for, fantastic moment, I suppose, in any private equity investor's career, but managing partner certainly even more so. So what is the one mistake that you see either private equity firms or portfolio companies making, and what action would you kind of suggest there to correct them?
Yeah, great question. Look, I will answer the question through the purview of our strategy at Levine Leichtman, which is slightly different than a traditional private equity or an LBO firm. So one thing that we don't subscribe to at Levine Leichtman is excessive leverage on companies and really utilizing financial engineering to earn a return. So I would say, you have to have been in this industry for a while. I've been doing this about 20 years. To realize sometimes what the perils are of excessive leverage. We've been in a market that's effectively been straight up into the right since about 2011, outside of a short time during COVID. So a lot of younger folks in our industry, they haven't lived through recessions, they haven't lived through inflation, they haven't lived through rising interest rates. But if you've been around, as an example, the Great Recession was probably one of my best times to learn about business and our industry and some of the perils of excessive leverage. So I would say that's one thing. And again, I'm answering this from the purview of our firm, which really utilizes, business building as the way to make money for our investors. Our goal and what we've consistently been able to do for 40 years is double, triple, quadruple, quintuple the EBITDA of our businesses. And that's really how we believe in making money, albeit with modest leverage. The other peril, I would say, what I'm seeing now in the private equity world is private equity firms prioritizing capital deployment and trying to deploy their capital as quickly as they can so they can go out and raise the next fund and grow their AUM. And I think at least the way I view the world, some firms could do that very well. Other firms, when you're prioritizing AUM and just building your firm as fast as you can, it all feels good and it feels right, and you can grow well as the market's going up into the right. But we are going to come into some tougher waters, and if you're not putting the thought into the right deployment, the right asset selection, the right value creation, which isn't always something that can happen quite as quickly, and you underperform for your investors, your firm can have a hard time. And, in the private equity industry, in many cases, unless you're really well established and you've been around for decades, you're only as good as your last fund. So, it's great to grow quickly, but if you're not providing good and consistent returns for your limited partners, I think you're going to have a short life in private equity. On the portfolio companies, the only thing I would say that I see happening sometimes is sometimes portfolio companies can be overly short-sighted. Meaning, if you take the spectrum of like a Jeff Bezos building Amazon, like he didn't care about making money or being profitable for decades, right? He was really building something and had a very, very long-term view. In the private equity world, we don't have the benefit of thinking that long-term, right? Because we generally have 10-year fund lives, and you got to build up these companies and sell them. But at the same time, that doesn't mean that we need to treat everything like a trade, try to get a couple of quick wins and flip out of companies. Because sometimes what you see is a private equity firm or a management team, they'll buy a company, they'll execute on some quick wins, maybe a pricing initiative, maybe some cost reductions, maybe some quick M&A that hasn't been integrated, that hasn't been thoughtfully done. And, they'll try to flip out of it. Whereas sometimes those actions have been done in a hasty fashion and don't create kind of a long-term value for the stakeholders of that individual portfolio company. So I guess my theme is, build things to last. Don't try to just do things too quickly to have quick success.
That makes sense. And obviously, well, when I looked on your website and started to do research on the firm there, I saw that kind of marketing and positioning around a slightly different approach to private equity. Why do you guys feel that, and I can guess, but why do you guys feel that the kind of lower leverage perspective is more beneficial? And also, does that come with any kind of challenges for the firm with regards to the types of deals you can invest in, or are you equally as competitive? You've just got a different process?
Yeah, it's a great question. So, we call our style of investing structured private equity. And what that means is in every transaction, we're investing a combination of junior debt and equity, and we're doing so alongside a management team that are buyers of equity. Lastly, we're control investors. We generally own on average, it can vary per transaction, but let's say we own about 75%, management owns 25%. I mentioned we invest the junior debt. We are taking, modest amounts of senior leverage in our deals, call it on average 3 times. Why do we do it that way? The reason we do it that way is, number one, is by investing that junior debt and that equity in growing businesses with high free cash flow, we can provide our investors a great yield on their money. So despite the fact that we're owning the majority of the equity and we can multiply that equity, on a multiple of capital basis, many times over, and still get the benefit of, the reason people like private equity and LBOs, where you can get that, 2, 3, 4, 5 times MOIC, we're also at the same time able to provide a great yield. And then lastly, from a downside perspective, we have a pretty phenomenal track record where in our core structured private equity funds, we haven't lost money on a deal in about a 20-year time frame. So why is all that important? Well, if I put it in the eyes of an investor, and this goes back to something I said earlier, from a limited partner's perspective, they're trying to create a portfolio. And they've been creating portfolios in the last decade that have been, whether it be venture, whether it be private equity, whether it be credit, everything's been up and to the right. And sometimes it's hard to think about downside protection and yield when, you've got the stock market inflated and the real estate market inflated and all these asset classes have been doing well. But, talk to our investors during the great financial crisis when we were still distributing money to them every month. We're selling portfolio companies. Our businesses were performing because our brethren in the private equity industry had 7 times leverage, which became 14 times leverage, and they were losing the equity in their businesses. And in our situation, because we were lowly levered, we could quickly throttle down that leverage through free cash flow and protect that equity and that security, that debt and equity security. So we've been able to perform for our investors for almost a 40-year period. The other thing I would say is, you asked about whether we are competitive. Well, in raising capital, investors tend to look at a fund, right? They don't tend to just look at an individual deal. And when you think about constructing a fund, most private equity firms, because they're using a lot of leverage, it's a risky asset class, they're going to have a couple times they lose money, a couple zeros in the fund. So when you have a zero, what do you need to do on the flip side to still get a good fund? Well, you need to find a way to get those 4 or 5 or 6 X's to counteract those zeros. And so when our limited partners look at our track record and they see a very low dispersion of returns, and without having those zeros, we're still able to keep up with the best in private equity, but do so with a lower risk profile. It's been really one of our keys to success with our limited partners and continuing to grow consistently over 40 years. Now, when you think about our strategy with respect to our management teams, our strategy really offers a huge benefit when you find those management teams that are dilution sensitive or very hungry to own equity. So because we are putting in that junior debt tranche, it allows the management team in many cases to own more of the equity. And by owning more of the equity and buying equity alongside us, we really self-select out of those situations where, the management team just wants to be a management team. They want to run the business and they don't want to be owners. And what we've found is when management teams really want to be owners and they're that bullish about companies and they want to speak with their wallet, those tend to be the investments that have, the most growth and the most success. So because our structure is different and because most management teams wouldn't tell you that they love 7, 8, 9 times leverage, and we come in with a different solution and we walk them through our playbook and how we work with our management teams and how we give them autonomy to run their business and they can own more equity, it positions us really well in the market to win over the hearts and minds of those management teams and win those deals that we really like.
It sounds like quite the USP. I speak to a lot of firms that are, in the low middle market that are in the real battleground of trying to win, that win that USP type fight, and some of them are going more niche with regards to sectors and drilling down in that. And it sounds like your financial structuring of how you're positioning things seems to be your USP, and then how you're operating through that with the management team. So that's really interesting. It's rare, if not, I don't think I've heard of anybody who's structuring things considerably different than the market. And I suppose that's obviously attractive for investors as well, who are looking for something different and standing out from the crowd, which in any industry can be very difficult. And obviously that includes private equity.
Yeah, you hit the nail on the head, Alex.
Great. So looking at the firm, obviously multiple offices, global investment strategy, obviously you've got your unique USP that you just kind of shared. What are some of the challenges that you face as managing partner with that kind of infrastructure and global outlook? And how have you kind of overcome them?
Yeah, it's a great question. Look, I think, as you said, there are challenges running a global organization, but maybe even starting with the benefits. And one of the big benefits we've seen to having a global organization is, look, as Thomas Friedman wrote a book about, the world's flat, right? We become very global. And just to be insular into the US when you're operating in a market that's global can sometimes actually be a drawback. So by having the presence that we have in Europe, what we've found is it's really helped not only our European funds, but also some of our domestic funds, whether it be on the fundraising side to get closer to our limited partners on a global basis. It's helped with origination of new deals. It's helped with diligencing those deals that have a global presence. And it's also really helped, I would say, with portfolio management and value creation. So that's one real benefit we've seen in the last 10 years since we built out our infrastructure in Europe. The natural challenge you have is, as I mentioned before, our firm is almost 40 years old and we do things a certain way and we think differently, right? Just like our strategy is different, we think differently. We don't think about financial engineering as much as we think about how to build these businesses and build them the right way over a long period of time.
Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast.
So the challenge is, how do you build a team throughout Europe that really has that same ethos, that has that attitude, that has that process and that training and that style of communication that we've built over a 40-year period here in the US and principally in our Los Angeles office. And I think we've done it in a couple ways, and I think we've done it really successfully. The first thing that we did is I talked about not trying to move too quickly, right? Everyone wants to go 5 years or 10 years after they develop something, go be the biggest in the industry. We built our US business methodically and had consistent growth, and that's how we viewed Europe. So we got into Europe about 10 years ago. We're really just kind of wrapping up the investments of Fund 2 now. So, we're not trying to be on Fund 5 10 years in. We're probably not too far off with Fund 3, but we built it the right way. We had a great Fund 1. It had great returns. We've deployed the capital largely in Fund 2. So that's the first thing, is we didn't rush into it. The second thing that I think we did really well is we hired locals in the various markets, whether it be in Stockholm, whether it be in the Benelux region. We just hired a gentleman to staff the DACH region for us. Obviously, we built out our corporate finance team in London. So we hired those local professionals that really know the market, know the teams, and know the right intermediaries. But we also filtered in some of our US team that were trained here in the US that really have that LLCP ethos. So by combining those teams together, it really helped the folks that were newer to our organization learn our processes. So that was helpful. The third thing we did is whenever anyone starts new in our European office, they generally spend, 4 to 6 weeks first in Los Angeles, where they see how we do things. They spend time with each of the junior and senior deal professionals to really kind of learn our way of thinking and our processes. The next thing is, pre-COVID, our US team was out in Europe, or the European team was out in the US a few times a year, which helps. And then we share one investment committee. So there's one investment committee for the whole firm. So as we're thinking through whether it be, new deals or value creation, you have those same group of partners who manage the firm sitting over both our US and our European team. So it's really helped to have that consistency and to build in Europe, a business very similar to what we built in the US.
Absolutely. That sounds like one of the questions is going to be, how have you kept culture? But I suppose that cross-pollination and you kind of basically the headquarters of Los Angeles and feeding out, taking people there, bringing people in. I think that's an important strategy to keep the culture of an organization. How have you found the differences between from a cultural aspect of the locations and regions that you've had, and maybe the different investing styles? Has there been maybe a little bit of change and tweak on that? Or has it been, okay, this is how we've done things, this is how we're going to continue to do things? What have you had to do there as you've opened up new offices? And obviously it sounds like you continue expansion.
Yeah. So what we found in Europe is, a lot of Americans think Europe is a place, right? Europe is a collection of so many countries that each have their individual styles and cultures. And, you can have two bordering countries that do business very, very differently.
Yep.
For example, like the DACH region relative to the Benelux region, it's very different relative to, Britain, right? These are very different markets. So the first thing I would say is, we really felt like having a local presence, having a German staff our Munich office, having a Dutch person staffing our office in The Hague, having a Swedish person staff our office in Stockholm. That was very important, because especially in those regions, nothing against American private equity firms, but generally speaking, those management teams, they don't want to go do business with Americans. They want to do business with someone they know, someone they can reference, someone who not only speaks their language in terms of just logistics, but their language in terms of customs, right? So I think that's something that was really, really important to us, and something that we learned kind of early on. In terms of differences, I would say the differences have been more on the margin, where the way we got into Europe was one of our largest LPs, who happens to be a European LP, came to us roughly 10 years ago and said, no one is doing in Europe what you guys are doing in the US. And I think there's a great market for it. And that LP said, look, we'll seed your Fund 1. Like, we're going to be partners. Let's do this together. We have that much confidence in the strategy. And we're very thankful for them, because they were right. And it's been very, very successful. But there are differences, like, for example, how you structure equity in Europe, right? As opposed to having like a common equity slug in the US, like we would have with our management team, and then options, they do these loan notes and sweet equity. So what does that really mean? It's not all that different for us, right? It basically acts the same way, but it's just a difference in vernacular and slightly different mechanics. this whole concept of a lockbox that they use in Europe, which effectively creates economic ownership. And as the cash builds until you sell a company, we don't have that in the US. It's similar to a working capital adjustment, albeit different, or even the legal documents, right? That generally speaking, a selling sponsor has very little, they're not really signing up for these reps and warranties, whereas in the US they would be. So, differences that we've had to learn over time, and by hiring that local talent and also having a network of the right advisors over there, we've learned how to do things, in those local regions.
Sounds like a great success. So you've mentioned about that connection internally, but what do you believe is key for that kind of successful relationship between private equity firm? You've already touched a little bit on it already, but also within the portfolio companies, senior management teams, and obviously the rest of the business, of course.
Yeah, so it's a great question. It's a really important question. So because our firm was founded by entrepreneurs who built and grew businesses, we weren't founded by leveraged finance professionals or Wall Street folks. We were founded by people who built and grew businesses, Arthur Levine and Lauren Leichtman. And what they've kind of infused in the ethos of LLCP is in the middle markets, the management team is like the engine of the car, right? That, if you were to go get a different CEO at Apple tomorrow, and nothing against Tim Cook, I think he's a great CEO, but I doubt Apple is going to change dramatically, over the course of a quarter or a year. But in the middle markets, that CEO or that management team is so critical for the success of that business. So that's one of the reasons why, going back to 40 years ago, we basically said, look, unless our management partners are buying a significant amount of equity alongside of us, we just won't do the deal. Doesn't matter how much we like the opportunity or the company, it is a hard no. So I think that's the first thing. And that really goes to alignment of interests, where, it's funny, sometimes we'll look to buy a business and the management team will say, gosh, I don't have any equity today. And look, there are a lot of firms who do things in a lot of different ways, and I don't want to disparage anyone. But when you have a management team running a business that you've put 50, 100, 500, $1 billion in, and that team doesn't own equity, like that would just scare me way too much. Like, you need that alignment of interest. So I would say a successful partnership between a private equity firm and a management team is first, alignment of interests, and two, kind of alignment on what is that plan to grow this business. And, there are a lot of successful private equity firms that are, more operationally focused. And they'll buy a company that, the management team says, look, our plan's to go left. And they'll say, okay, it's our strategy, buy the company, fire management, put in a new management team and go right. And there are firms that do that well. That's not what we do well. What we do well is, not only do we have to have that management team who are buyers of equity alongside of us, but we need to sit down and have an honest conversation with each other about what are our goals, how are we going to get there, what's the plan, how much investment do we need, and kind of get on the same page at the outset. And, the way we operate is, we largely defer to the management team to run the business day to day. And it's those larger strategic items that we'll get ourselves involved in. And we never want to get in a situation where a management team says, yeah, I want to go do 10 add-on acquisitions in this ancillary market that we don't agree with. If we don't agree with it, I'd rather tell them up front and make sure that if we do a business deal together and we're effectively married for, 4, 5, 6, 7 years, that we're getting on with a shared vision versus getting in the deal together and they say, oh, LLCP, we didn't like this idea you had, or LLCP says the management team, oh, I know you want to do this, but that doesn't work for us either. So kind of getting agreement up front is really, really important.
Completely makes sense. And what are some of the trends that you're seeing within, that might be too much of a big question, but what are some of the top trends, I suppose, that you're seeing within the industry at the moment, obviously with not only a US outlook, but a global outlook too? Yeah, so two things I would say. The first is, I mentioned this before, a very rapid pace of deployment of capital. We hear from our limited partners, and I think 2022 will probably be the busiest fundraise year ever. But what we're hearing is, a firm used to deploy a fund in 4 to 5 years. We're hearing about firms coming back to the market in 12, 18, 24 months and wanting to go upsize their funds. So that's been really, really prevalent over the course of the last few years.
definitely much more so than when I got in this industry 20 years ago, but even more so than 5 or 6 years ago, right? We're really seeing that pace of deployment accelerating. The other things that we've seen, which is probably a dynamic that's really heated up in the last 2-3 years, is the secondaries fund business, where private equity firms are either doing single asset secondary funds or multi-asset secondary funds, where they can hold these assets longer, raise new capital to allow firms to kind of do more with the business than they could in their existing fund. And we've heard mixed things. In some cases, we've heard LPs like it because LPs have the option to cash out when there's a secondary fund or roll into the secondaries fund. And we've heard other LPs not like it. So I think it is very situation specific and LP specific as to, how those secondary funds are received in the market.
Absolutely. And what educational kind of resources would you recommend that others kind of check out in the market?
Yeah, I mean, it somewhat depends upon if you're in this industry and understand it versus if you're, younger and looking to get into it. But, there's a lot of great daily email blasts, like a PE hub, which really helps you stay abreast of what's happening in the industry, deals that are getting done, industry trends, what's happening with people moving firms, et cetera. So I think that's really good. And then in terms of like case studies on value creation, there's a couple different publications that'll do like deal of the year awards, turnaround deal of the year, mid-market deal of the year, large deal of the year. And sometimes I'll say, look under the hood of some of these deals because, we as private equity investors, we can talk to our limited partners, quite openly about what we do and how we do it and all the levers we pulled. But in a situation like this, because of different SEC rules, I can't give you, as much transparency as I could if we were like officially raising a fund and we're speaking to folks who signed NDAs, et cetera. So sometimes it's harder for, someone to really get under the hood. So I've always found those case studies to be really, really good. Obviously reading the Wall Street Journal every day is great just to stay abreast in what's happening with the broader business landscape. But I'm a huge reader. I love nonfiction business books. So a few books that I wrote down that I think are great if you're interested in the private equity industry. King Icon, which is Carl Icahn's book, was great. Play Nice But Win, which is Michael Dell's book. Again, he's not a private equity guy, but he did do a big private equity deal. And it's really interesting to kind of understand how that came together and differences between running a public company and a private company. Caesar's Palace Coup was a great book all about Harrah's and some of the fight between Apollo, who is the sponsor, and the creditors. And it gets technical because it gets into different layers of capital and different layers of debt capital and different constituencies and how they fight in a bankruptcy. But to me, it was super interesting. King of Capital, which is Schwartzman and Blackstone, was a great book. And then the classic like Barbarians at the Gate, right? You can learn a lot about what we do, and these are all fantastic stories and make for good reading.
Absolutely. Well, I've read the first and the last, so I'm two of quite a long list there. So I appreciate you sharing that with Carl Icahn and Barbarians at the Gate. So I thought we were getting through that, and I was like, God, I've only read one of these. But yeah,
I can recommend many. Well, it's funny. Those are the books that I kind of thought about that are private equity specific. I would say if you're really interested in private equity, don't only read private equity books, but I mentioned like Amazon, like read books about how Apple was built, read books about how Amazon was built, read books about like Elon. There's a book called Elon Musk reading about like what he did with Tesla in the early days, how he built SpaceX. But, sometimes people in finance, they get so myopically focused on the financial side of it, when the reality, the value creation, especially in today's market where the multiples are so sky high, are in how you build and grow a business, which yes, finance is interwoven in that. But to really understand how these greats had, Sam Walton's book about how he built Walmart. I mean, I could go on and I could probably give you 40 examples of different biographies and autobiographies I've read of successful founders. But I actually think that's another great avenue to go down to really understand kind of operations and sales and all the aspects and, how you build a business.
Absolutely. I think I'm completely the same. I'm a big reader and read, obviously being executive search, read everything I can with regards to talent and hiring. and then going into how businesses have been built and how they've been grown as I continue to grow this business. So it's there's a whole myriad of areas that you can go into and different avenues. So, and I agree, a lot of the stuff that I've learned a lot about talent and hiring process have not been, specific hiring books, as a lot of them are, to be honest, pretty basic with regards to go out there and get your name out and hire good people, is some of their simplicity. Whereas actually some of the business books that are actually talking a lot, and the guys who built businesses, whether it be Jeff Bezos or whoever, and they're kind of documenting those, or people who are studying what they're actually doing and how they're attracting people, tend to be a great way to learn. So I think that's a really good message there, Matt. Appreciate that. And there's a few there that I'll be certainly getting onto Amazon and purchasing post this conversation. So if anybody wants to reach out to you guys and the firm there, how best do they to kind of look you guys up and begin to get a picture of the firm?
Yeah, best go to our website, and I think there's like a general email address or phone number.
Perfect. Well, I'll stick that in the show notes as for anybody who can jump on. Well, Matt, look, I really appreciate you joining. Obviously, got a lot of passion, a lot of knowledge on the industry, and appreciate you sharing that as well. As you mentioned, obviously, we are wrapped up with depending on what financial restrictions and considerations you're under with regards to what you can share. So thank you very much for giving us an insight to what you guys have done, the different structure that you guys operate, and also that global outlook that you have within private equity and keeping that culture. So thank you very much for sharing everything you've done today.
All right. Thanks, Alex.
Brilliant. As always, thank you very much for joining us. And of course, should you ever need support with private equity professionals or portfolio executive hiring, please do reach out to me at Raw Selection. But till the next time, keep smashing it. And thank you very much for watching.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.